Methodology settings are the engine that keep your Right Capital plans running. Within the gear icon, Settings, Methodology tab of each plan, you have complete control over the calculation options that will impact all facets of a client's future-looking projections. By taking the time to review these settings and understand how the software interacts with your data entry, you'll build the confidence to present planning modules with a deeper understanding of how results are generated. This ultimately leads to a more persuasive presentation that instills trust and satisfaction in your clients. In this training video, we'll review each setting that can be found on this page and the impact that it will have within your client plans. Near the end of the video, we'll also touch on how you can set the global presets for each one of these settings to better align with your unique advising philosophy. Before diving in, I want to quickly mention that in this video, we'll be spending most of our time exploring the top 6 settings listed on this page. While all of these settings are important in their own way, the first 6 are going to have the biggest impact on almost all of your client plans in Right Capital. If you'd like to skip ahead to a specific setting, you can find timestamps listed in the YouTube description below the video. Let's start by reviewing the planning method. This is one of the most important settings in Right Capital as it determines the type of planning that we'll be doing for a given client. Right Capital's planning framework allows you to create cash flow-based plans as well as goal-based financial plans. The first 2 options, cash flow-based and modified cash flow-based, are both cash flow-based planning methods. Cash flow planning requires income and expenses to be entered during the initial data entry process and will project comprehensive year-to-year cash inflows and outflows within the plan. The calculation for this is simple. Cash inflows minus cash outflows equals net flows. The main difference between these 2 options is in the way that they handle excess cash flows. When a client's cash inflows outweigh their cash outflows in a given year, the traditional cash flow-based option assumes that all cash flow surplus will be saved and reinvested into the client's taxable investments. When using this option, excess cash flows that are being saved and reinvested will appear in the net flows column of the Retirement Cash Flows Summary table. Because every penny of excess will be saved and reinvested into the taxable account bucket, you won't be able to manually add taxable savings cards when using this option. That brings us to our next option. The modified cash flow-based planning method is similar to the traditional with one major exception. Any excess cash flows are assumed to be spent rather than saved, unless otherwise indicated within the plan. When using this option, a new Spend Unsaved Cash Flows column will appear in the Cash Flow Summary table, reflecting any excess cash flows that are being spent off within the projections. This option also enables you to manually enter taxable savings cards within the plan, which allows you to specify exactly how much excess you'd like to save and for exactly how long. One last note on the modified cash flow-based planning method. Even when using this option, certain kinds of income will always be saved rather than spent within the projections, even if you don't enter any taxable savings. This primarily includes inheritance income, positive cash flows from the sale of stock options, and any proceeds from the sale of a real estate property or business. The last option for planning method is goal-based, which is the most different of the 3 options. Unlike cash flow planning, goal-based planning mostly ignores income and expenses and instead looks only to goals, savings, and account information to sketch up a rough picture of retirement. Using this method simplifies the data entry process, requiring only the client's current assets and liabilities, savings, retirement spending goal, and other key financial goals. Within the income and expense sections of the profile, there will no longer be an option to add new data cards. Without income and expenses to consider, the retirement cash flows will also be limited to just the net worth and accounts tables. The main thing to keep in mind when it comes to goal-based planning is that this does prevent you from using some of the other modules outside of the retirement module. Some planning modules in Right Capital do rely on income and expense information to function properly. For this reason, goal-based planning is not recommended if you wish to use other tools besides the retirement module for a client. The next setting we'll be reviewing today is the Cash Flow in Simulation Start setting, This setting determines the start date of your cash flow projections, which can be an important variable for clients who are focused on the short term. Right Capital offers 3 different options to choose from, the first of which is January 1st of this year. With this option selected, the cash flow projections will begin on January 1st of the current calendar year, with each cash flow year reflecting January 1st through December 31st of the year listed. January 1st of next year functions mostly the same way, except it will start the cash flow projections on January 1st of the following calendar year. The current calendar year will be excluded from the projections, so be aware that any income, expenses, or goals that are occurring in the current year won't be reflected in the plan when using this option. The main thing to keep in mind when using the January 1st start dates is that the account balances listed in the net worth section of a client's profile will be used as the starting balances within your cash flow projections. Because these account balances are typically current balances, it can be a good practice to use January 1st of this year in the earlier half of the calendar year, and then switch to January 1st of next year in the latter half of the calendar year. This helps keep the client's current balance sheet more closely aligned with their year 1 cash flow projections. The third option for this setting is current month, which is sometimes called the rolling 12 months option. Rather than starting on January 1st, this option will instead use the first of the upcoming month as the cash flow start date. Within the cash flows, you'll see everything projected out for annual periods, labeled using the year at the end of the period and the client's age at that time. For example, let's say that today is February 10th, 2024. The start date of the cash flows would be the first of the following month, so March 1st, 2024. The first row of the cash flow projection will reflect March 1st, 2024, through February 28th, 2025, and will be labeled as the year 2025 with the client's age as of February 28th. This option comes the closest to aligning a client's current balance sheet with their cash flow projections. Do be aware, though, that when using this option, some cash flow items may be offset within the cash flows depending on the time of year that they occur. For example, if a client's Social Security begins on July 1st, 2024, and your cash flow start date is March 1st, 2024, Social Security benefits will begin in the cash flow year that's labeled 2025. Up next, we'll be taking a look at the withdrawal sequence setting. This is an important variable, particularly when using a cash flow-based planning method, as it determines the order of accounts that will be withdrawn from when cash flow deficits occur within the projections. The default setting for the withdrawal sequence is taxable, tax-deferred, tax-free. With this option selected, Right Capital will first pull money from the taxable account bucket in years when a client's cash inflows are outweighed by their cash outflows. Once the taxable account bucket is fully depleted, it will then dip into the tax-deferred account bucket. Only once the taxable and tax-deferred buckets are both depleted will it withdraw from the tax-free account bucket. The impact of the withdrawal sequence can be best visualized in the Retirement Cash Flows Accounts tab by viewing the ending balance by accounts and withdrawal from accounts tables. Here, you'll be able to see withdrawals shifting from one bucket to the next as each bucket is depleted. In addition to the default sequence, Right Capital gives you 5 additional sequences to choose from for a total of 6 options. You can freely switch between withdrawal sequences without losing any plan data, which can be useful for visualizing the impact of different sequences on a client's plan. A few additional notes on the withdrawal sequence. Speaking generally, when Right Capital dips into an account bucket to fund cash flow needs, it will draw pro rata from all accounts within that bucket. So, as an example, let's say you've chosen a withdrawal sequence that starts with the tax-deferred account bucket. If the tax-deferred bucket within a plan is made up of 2 401k accounts, one for the client and one for the co-client, it will draw proportionally from those 2 accounts to fund cash flow needs. Additionally, when implementing a sequence that draws from the tax-deferred or tax-free assets first, Right Capital will default to withdrawing from taxable assets in the years prior to the clients turning 59.5. This is a built-in safeguard to prevent withdrawals that would incur penalties. Moving on, the planned distribution method setting determines how required minimum distributions and manually added income distributions will interact with each other, As a reminder, Right Capital will automatically calculate RMDs within the projections based on year-end account balances. And income distributions are data cards that you can add in the Profile Income section to manually distribute assets from a specific account bucket at specified times. The first option is RMD added to manual distribution. With this option selected, Right Capital will combine income distributions with the calculated RMD amounts in years where both occur. For example, let's say you've entered an income distribution card into a client's plan and set it to distribute $10,000 from the client's 401k in 2025. If the client also has a 401k RMD of $50,000 in 2025, the full distribution amount for that year will be $60,000. You can track both RMDs and manual income distributions within the planned distribution column of the cash flows summary table. The second option is greater of RMD and manual distribution. Instead of combining RMDs and manual distributions, this option will cause Right Capital to choose whichever is higher between the two. In the same example I just used, if there were both a $10,000 manual distribution and a $50,000 RMD occurring in 2025, Right Capital would choose the higher amount, which is the $50,000 RMD. The last option is no RMD, manual distribution only. With this option selected, Right Capital will not automatically calculate RMDs within the projections. Only manual distributions entered with income distribution cards will be reflected in the plan. This is a useful option if you'd prefer to enter a client's RMDs manually, rather than having Right Capital calculate them automatically. Next, let's review the allocation method. This setting determines how a client's investment allocation will be projected out into the future within the projections. This can have a substantial impact on investment returns and overall volatility within a plan, and by extension, the probability of success. The default option here is same asset allocation for all years, which will use the client's current allocation as the long-term rate of return within the plan. The current allocation is the blended result of all of the investments entered within the net worth. You can view the current allocation and its annual return percentage within the Investment Asset Allocation tab of a plan. The best place to visualize your chosen allocation method is within the Allocation Path tab, also located within the Investment module. This chart here will highlight year-to-year changes in a client's asset allocation over the entire duration of the client plan. The second option is pre- and post-retirement allocation. With this option selected, Right Capital will use the client's current allocation in pre-retirement and will allow you to specify a different model portfolio to be used in post-retirement. You can specify the post-retirement model within the post-retirement allocation for current plan field that appears below the allocation method. The third option is Enable Glide Path, which will model a gradual transition in a client's investment allocation over time. You'll also find a new field for the grading schedule, which determines how quickly the client's current allocation will transition to match the allocation of your chosen glide path. It's worth mentioning that you can create new model portfolios as well as new glide paths within the Models tab of your advisor portal. The last option is no blending across account types. With this option in place, Right Capital will use the individual rate of return associated with each investment type, rather than a blended rate when calculating portfolio return. In other words, all investment types will grow based on their own separate rates of return. Do note, though, that this option prevents you from implementing glide paths or pre- and post-retirement allocations and makes it impossible to propose a new asset allocation in the Retirement Analysis module. The last of our top 6 settings is the cash management method. This setting determines how bank accounts will be treated within the plan and how a client's taxable account bucket will be divided between the cash reserve, which grows at cash rates, and taxable investments, which align with the allocation method. You can visualize a client's cash reserve as it's projected out into the future within the Retirement Cash Flows Accounts tab by clicking into the taxable column. 2 of the 3 options available for this setting will treat bank accounts as cash. In other words, the bank accounts entered within the Profile Net Worth section will be used as the cash reserve portion of a client's taxable bucket. The main difference between these two options is whether cash will be spent before taxable assets or after taxable assets in the case of negative net flows. The default option in Right Capital is to spend cash before taxable investments, which will deplete a client's cash reserve before ever dipping into their taxable bucket. If you'd prefer to shelter the client's cash within the plan, you can choose the spend cash after taxable option instead. The third option here will use a cash reserve goal to manage cash levels. This option enables a cash reserve goal card within the Profile Goals section, which you can use to precisely specify the dollar amounts kept in the client's cash reserve over time. Within this goal card, you'll enter the target amount for the cash reserve, the duration, and any annual increase. Within the projections, the assets within the taxable bucket will shift to align with your specified target amounts and duration for the cash reserve. When using this last option, it's important to remember to add a cash reserve goal in the goals area of the profile. If no cash reserve goal is entered, the entirety of a client's bank assets will be invested, which can skew your output. If you wish to use this option, be mindful to double check that one or more cash reserve goals are present within the profile. Now that we've taken a look at our top 6 settings on this page, let's quickly review the rest of our methodology settings before diving into client presets. Each of these settings are impactful in their own way, but tend to be a bit more situational than the ones that we just reviewed. If you'd like to automatically distribute interest and dividends from taxable accounts as income within a client's plan, you can do so using the setting labeled Distribute Investment Income from Taxable Account. You can have this start right away using the Every Year option, or once clients retire using the After Retirement option. When set to Never, interest and dividends will be assumed to be reinvested and will be factored into the client's portfolio return. For clients with HSAs, the Health Savings Account distribution setting determines when the system will start using HSA assets to fund medical expenses. By default, this will be set to immediately, but you can delay HSA distributions until first retirement, second retirement, or until a specific client age or calendar year. The retirement expense timing setting allows you to choose when the plan will switch from pre-retirement living expenses to retirement living expenses. You can set this to happen when the first client retires within the projections or when the second client retires. The Include Bank Accounts in Asset Allocation chart setting can be checked to include a client's bank accounts in the current allocation pie chart that we viewed earlier in the Investment Asset Allocation tab. This is a purely visual change and will not impact the investment returns within the retirement projections. With this setting unchecked, only accounts in the investment section of the net worth will be included in the chart. Allow display of scenario-specific cash flows can be checked if you wish to enable custom return scenarios within the Retirement Cash Flows module. Return scenarios are a feature that allow you to inject some volatility into a client's cash flow projections. If this is a feature you're interested in utilizing, you can find lots of resources dedicated to return scenarios within the Right Capital Help Center. The Take Annuity RMD from IRA Account First setting allows you to delay taking withdrawals from qualified annuities with a lifetime income guarantee by satisfying the annuity's RMDs from the client's traditional IRA accounts. This allows clients to delay withdrawals on the lifetime income annuity in order to provide a higher guaranteed income amount in future cash flows. If the setting is unchecked, Right Capital will calculate the RMD for lifetime income annuities each year, starting in the year that the client hits RMD age. Right Capital will distribute the greater of the RMD amount or the client's lifetime income amount in each year. The next setting is use taxable accounts to fund IRA and 529 saving when current year cash flows are inadequate. Checking this setting will cause Right Capital to automatically liquidate taxable assets to fund IRA, Roth IRA, and 529 savings in years where clients don't have sufficient cash flows to make those savings. If unchecked, Right Capital will only reflect IRA, Roth IRA, and 529 savings in years where clients have the available cash flows. In years with cash flow deficits, these contributions will not occur. The next setting allows you to specify if 529 accounts will be used to fund pre-college education goals. When checked, up to $10,000 per year will be automatically distributed from a client's 529s to fund pre-college goals. If unchecked, 529s will not be used as a funding source and will be reserved exclusively for college goals. Our last two settings will only appear on this page if you're using modified cash flow based as your planning method. The first of these can be used to move taxable savings from the net flows column to the planned savings column within the cash flow summary page. This is purely a visual change, but if you prefer to see a client's taxable savings appear alongside the rest of their yearly savings, you can check this box. The last setting is Spend Unsaved RMD/distributions. This allows you to choose whether or not a client's RMDs and income distributions will be saved or spent by default when using modified cash flow based as your planning method. Checking this box will cause any cash flow excess that stems from RMDs and distributions to be spent unless otherwise indicated within the plan. Unchecking this box will cause Right Capital to save and reinvest any excess from RMDs and distributions. At this point, you likely have some general preferences for some of these settings that align a bit more closely with what you'd like to see across the majority of your client plans. While you can always adjust the methodology settings on a client-by-client basis, it can be helpful to choose which options you'd like to use for new client plans as a starting point. This is something that you're able to do back within your advisor portal by navigating to the Client Settings, Client Presets tab. Within the methodology section at the top of this page, you'll find the same list of settings that we just reviewed at the client level. This page allows you to set your default settings presets that will be used within newly created client plans going forward. For example, if you prefer goal-based planning and want to use the goal-based planning method as a starting point for new clients, you can select that here. If you'd prefer your plans to have a glide path in place right from the get-go, you can select that for the allocation method, and so on. By reviewing this list and making your selections, you can more closely align the planning output in Right Capital with your unique advising approach and philosophy. Do note that making changes to this page and clicking Save will not impact the settings for any of your existing client plans in Right Capital. Any changes made to your client presets will only be applied to new clients that you create from this point on. If you have any additional questions about any of the methodology settings reviewed in this video, know that you can always reach out to the Right Capital support team for assistance. You can use the live chat feature in the lower right corner of your screen, or you can give our team a call at 888-982-9596, option 2. For tutorials like this one focused on other areas of the software, you can visit the training videos section of the Right Capital Help Center.